Hey friends, Coach Ernie here. Today we're going to talk about options. Now, options, if you're not new to options, it can be quite complex, a little bit scary, but it really isn't. It's perhaps the gift to traders. And why is that? Why do I say it's the gift to traders? I say it because options lay it out there for you. It gives you the odds that the market is laying down for virtually every single asset out there. And that's fantastic because not only does it lay the odds down, but it gives you the tools as well as a variety of option strategies to be able to dial in your potential for profit and your return on capital. Incredibly powerful tools. The problem is that most people don't really understand what options are. They think that they're primarily built for leverage. And of course, options can be used that way, but if you don't really understand the full aspect of options, if you don't understand what they're really for, they're there to model your idea of what the market is. And that is typically taken in what I call 3 dimensions, or the 3D options strategy. And those 3 dimensions are time, how bullish or bearish it is, and volatility. And so, for instance, you can use all of these things in determining whether or not something is going to go up or down or stay the same. And that's really the cool part about options, that with options, you have the ability in some strategies to make money, whether price goes up, goes down, or stays the same. Some strategies, it's just up or down, up or stays the same. Some, there's all different combinations. You can take strategies that have unlimited risk. Even though they say they have unlimited risk, they're usually the better option in terms of overall profitability. Or you can have options that have very limited, well-defined risk. So you know exactly what your maximum loss is going to be before you even take the trade and know what your potential profit is. You can have some things that have limited risk and unlimited potential profit. Sounds enticing, right? Don't get too excited yet, because without a full understanding of how options work, all this information is completely useless to you. And unless you actually use options the way they're meant to be used, chances are that you're going to fail. But if you really understand them, options can be the most wonderful tool you could possibly imagine for the trader. So the first thing is, to choose, well, before that, you need to understand it, and I'll be covering what options are and how to use them, etc. But the first thing that once you get that under your belt, what you need to know is, what strategy am I going to use and under what conditions? So am I bullish? Do I have enough time left in the contract? And will that work for me or against me? Is there volatility? Where is it? Is it low? Is it high? Is that good or bad for my strategy? All of these things, these are the 3 dimensions that you have to use in order to pick the proper strategy for what you want to do and what your idea of the market is. And so what I have here is what I call my 3D options guide. And what it does is it lists on the left-hand side all these different various strategies. Now, of course, there are many more strategies than this. What I did was I took some of the representative ones for each of the, what kind of market it is. Is it a bullish market, a bearish market, or is it a I don't know market? And that's what I call the neutral strategy. So we have representative strategies, which are combinations of long calls, short calls, long puts, short puts, longs, calls, puts, and different variety of different ratios, etc. And you can create these very different risk profiles, and I'll go over a few. So the options guide, if you want this, by the way, let me know in the comments, and then I'll make that available to everybody. In the next video, I'll put a link on how you can get to that. And I'm actually going to be incorporating this guide as well as relevant strategies in my volume profile book for traders. So what's it going in there for volume profile? Well, volume profile to me is an indispensable tool when doing any kind of trading, so that I really have a better feel for what the market structure is. Anyways, as you can see on the left-hand column, as I said, first of all, you want to pick what kind of temperament you have for the market. Where's the sentiment? Is the market bullish, bearish, neutral? Let's say it's bullish. And then from there, you can see that there are different types of bullish strategies. Some are debit, some are credit. Basically what that means is some will actually cost you money, others you take in money, or some you're a net buyer of premium, and others you're a net seller of premium. In other words, the money comes to you. And without trying to get too into it, because I don't want you to get too confused about it, but just take it for granted that being a net seller of options, there is generally a higher probability for profit as a net seller in the long run. So then you choose, how bearish or bullish that you want to be, and you see that I have check marks that say, hey, this is the proper strategy for that thing, and then whether or not volatility is increasing or decreasing, or don't care, right? And then, is time working for you? Is this option about to expire, or does it have plenty of time to expire? And is that situation in your favor or not in your favor? I know there's a lot of moving parts. It is really, but when you think about it, it allows you to really dial in. And not only that, you can then within each one of these strategies construct it in such a way that you can dial up how much risk that you're willing to take and what you want to be for the probability of profiting on that particular strategy. So as a systematic trader, if you trade small enough and you trade enough of these strategies, you're doing something that I often profess, and that is to trade multiple non-correlated strategies where you have where you know where your edge is. You know what your potential for profit is, what your potential return on capital is, and what you're going for. These are all critical elements, and we're going to do the same thing for futures in the near future. So what I'm going to show you now is, well, we showed the S&P in the previous video, and we can see here that this is the SPY, and I'm showing the SPY only because there are some readily available, very popular option contracts for SPY. And according to the volume profile, we're pretty up there, right? And we're right on the edge. And there's a lot of resistance here. There is some support. But if you look at this kind of wave pattern that we're experiencing here, in this what appears to be a topping pattern, it looks like we may roll over a bit. And with volume profile here, it looks like we might have a chance to come down and meet this volume node here. There's a high potential for that, in my opinion. All right, and so that price right at that point is 278, 279. To me, it looks like we're coming down here. So I'm a little bit bearish on this. Volatility, where's volatility? It's a good question. And up in the upper left-hand corner here, you see I have SPY. If I want to know what the relative volatility is, I have a script running in each of the charts. So when I put an ETF or a stock in there, the script in the upper left-hand corner will tell me what the implied volatility ranking is over the past year. And so right now it is at 13%. Now what that means is that volatility relative to the volatility over the past year. So if I took all the history of volatility over the past year for the SPY, right now the ranking for the current level of volatility is in the 13th percentile. That means that it is really low compared to where it was. Now what that means in terms of options, now you may know this, may not, but options are made up of a couple of different components. Part of it is its intrinsic value, its base value, and the other part is its premium. The premium is made up of of a combination of things that are dictated by time and the relative amount of volatility. When there's very little volatility, premium starts shrinking. And so then the cost of the option starts going down. In other words, it's starting to get cheap, right? So when premium is very low and I have maybe the inkling that it's going to go down, that means buying an option is a better option. Buying a long or buying a put is better because it's cheaper. If premium was very high and thick and heavy, then selling that option would make a lot more sense, because when I have a lot of premium, that means there's a lot of premium to sell and for me to make money. Now, in this particular case, premium is very thin. There's not a whole lot of it. So if I were to predict in the future, if there's very little premium here, the odds of premium increasing are higher than them going down. So being a buyer, a net buyer of an option, in other words, a net buyer of whether or not it's premium laden or a debit or a credit. See, a debit is basically buying, a credit is basically selling. Then I'd be better off being a debit trade. In other words, I want to be a buyer, expecting that that premium is going to increase, so that by the time it reaches my expected target, perhaps that premium has increased, and not only will I make money on the movement of the option and the underlying price, but I'll also make money by the expansion of that premium. I know, that's a lot. It's a lot to take in. And these are the type of things that I will teach people in my coaching. Now, here's a long call, one contract of the SPY. And we can see that we're risking, now this blue line here represents where the profit will be at expiration, and then along the x-axis you can see the pricing. So currently the pricing is at about 281. The price can go up, it can go down. Now, this purple line represents the amount of premium in this option. Now, as time goes on, I'm going to advance the clock here. You'll see that as time goes on, that premium starts meeting up with the price at expiration. In other words, it's diminishing. And that's why time is a problem, because as time goes with a long option, that's value in an option. See, that purple line, even though it also represents premium, it also represents the price at expiration plus the premium. So that's the actual price of the option. So if I were to look at the price, the expected price on August 29th, in order to break even, SPY would have had to have increased by 281 all the way up to 284. That's just to break even. So it would have to go up three whole points just to break even. So time is against me in a buying of a long, and it's the same thing in buying a put. I can go back to the current day. Today is the 13th or the 14th. Today's the 24th. Yep. Good to know what day it is, Ern. June 24th. There we go. All right. So here's a put. Now, if we do a long put, in other words, we buy this put, you can see what the current price is right here on this purple line. As time goes on, now let's say that we're expecting price to go down. If price goes down and volatility increases, then the rate at which this purple line starts coming towards the blue line is going to slow, because premium will get inflated. And that will be in our favor, right, as price goes down. Now, this gray area, light gray area, is showing you one standard deviation, or about the 70% chance, the 70% probability of which way price is going to go. It can go up this much, down this much, up one standard deviation, down one standard deviation. So by the time we receive, now, of course, as time goes on, that's going to change. You know, what is our probability of profit? Depends on where that price is. All right, so now let's go back to, now there are other things that we could choose. We could also choose like a vertical. Now this is a bullish vertical. Here, I am also looking for price. And you can see if we move into this area, we can make a lot of money if it moves up. If it moves down, we can lose a lot of money. But I've figured this spread in such a way that our potential for loss is less than our potential for gain. Our potential for gain is about $1,000. Our potential for loss is about $600. That's pretty good. Those are pretty good odds. So if you can put trades on like that consistently, and you can fall inside the area where you think that you're potentially going to go or profit, you can do very, very well. This is what I'm talking about, sort of dialing in your risk to reward as well as your probability of profit. We can also look at another type of strategy. This is more of a neutral strategy called an iron condor. Here, an iron condor, we could stay the same if we price stayed right here, or moved to the left, or went down, or even went up. As long as it stayed inside this range here, we'll make money. Because what will happen as time goes on, that purple line starts increasing, and as long as we stay inside there, we're profiting. And of course, there's a maximum level of profit up here, which is about $1,200, and the max that we can lose is about $800. So again, a larger potential win than loss, plus we have the added capability or potential that price isn't going to move that much. Now, that all depends on our future outlook. All right? So as you can see, options really do have a lot of flexibility here and can really design very closely your outlook, your modeling. They can model your idea of where the market might go and when it's going to get there and how fast and how hard. So that's sort of just a very, very broad overview of how options are actually used. And what I'm going to do in future videos is start dialing in on each one of these aspects. You know, dialing in on how we can isolate volatility or price or time. You know, we can put all of those things individually in our favor, and we can play that as if it is its own kind of thing, right? Where the price maybe not matter, maybe only the volatility matters, and so that I could play just that. That's kind of interesting. We can also, because we can dial in our probability of profit and our return on capital, and because we have our choice on how many contracts that we want to actually commit to the trade, we can really dial in our specific risk parameters, and we can put a lot of these trades on, even with relatively small accounts. And as long as we're following this sort of rule of large numbers, we put enough of these trades in that are kind of following our model portfolio. Say, I always want to work where 70% probability of profit with a 50% return on capital. Just a number. If I were able to put all the trades that I have and put them on like that and put a wide variety and always meet those kind of parameters over a long period of time, albeit no outliers that happen, that is where I'm going to be going. So I can actually dial in some predictability to my overall trading potential. All right. I know this was kind of a long video. There was a lot to cover here. I'm going to sort of finish up and go back to the options guide. I'm going to turn this into a PDF, so if you're interested in this, again, comment below. I'd love to hear what you have to say, and we'll see you next video.